Unlike shares of stock, which you can hold virtually forever, options possess a unique superpower and a curse, a ticking clock. The exact second you open a trade, a countdown begins. Every contract has a fixed expiration date, a hard zero where its fate is permanently decided. If you don't understand how this clock works, you are just a passenger on a train heading straight into a concrete wall. Think of an option like a commercial plane ticket. It has a strict departure window. If you don't board by that exact date, it becomes nothing more than a worthless piece of digital paper. At expiration, the game is officially over, and only two paths remain. If your option is in the money, meaning the asset price crossed your strike and holds real intrinsic value, the contract is automatically exercised. You collect the cash difference or swap the underlying shares. But if it's out of the money, the option expires completely worthless. Its value drops to an absolute, irreversible zero. Why does this happen? Because of an invisible mathematical force called Theta. With every passing day, time leaks out of your contract. But here is the real secret. This leak is not a straight line. As you approach expiration, especially within the final 30 to 45 days, the curve turns brutal. Time collapses. If you are an options buyer, time is your #1 enemy. It bleeds you dry. But if you are a seller, expiration is your ultimate edge. Time becomes your employee, grinding down the option's value and turning someone else's melting asset into your pure premium profit. This is where the true weight of expiration hits. It's not just a date stamped on a contract. It is the strict time limit you have for your thesis to become reality. You can be 100% right about the direction. You can anticipate exactly where the price will go. But if the market moves too late, expiration turns a perfect analysis into a 100% loss. In the world of options, it's not just about where the market goes. It's about when it gets there. Stocks give you a lifetime. Options do not. Every single contract comes with an end date, a final moment where probabilities vanish and only the mathematical outcome remains.